Hello, welcome to another episode of the Capital Employed podcast. For this episode, we had the pleasure of being joined by Christopher Godfrey, who is the founder and portfolio manager of Headwaters Capital Management. Before we begin, make sure to add your email to our free newsletter. Going forward, we will also be publishing interviews with fund managers in written format. So if you want to receive these interviews directly in your inbox, go to capitalization.com. That's capitalization.com and add your email to the list. You can also find the link to the newsletter in the show notes. Okay, let's jump into this week's episode. Please enjoy my conversation with Christopher. Hi Christopher, thanks for coming onto the podcast. Could you provide a brief introduction of yourself and Headwaters Capital?
Sure, John. Appreciate you having me on. Excited to do this. Before we get started, though, I just need to provide a little bit of a legal disclaimer. Investing involves risks and uncertainties. Nothing discussed in this podcast represents investment advice. I advise all listeners to do their own due diligence on anything mentioned in this podcast. So with that out of the way, we'll kind of jump into everything. My background's actually in credit. I started right before the great financial crisis in banking, and that provided a lot of great experience just in terms of analyzing businesses and industries and understanding, how companies, could navigate a very difficult economic environment. So I did that for a number of years, but I always wanted to be on the public equity side. And so I eventually made the transition to work at a large, long-only mutual fund, where I was an analyst on two small cap funds. Both funds had a growth bias, really kind of fit with my investment philosophy. So phenomenal career experience at the mutual fund, learned a lot from my peers, but ultimately I was a casualty of industry consolidation. And it was kind of a crossroads in my career, to be honest with you. I'd always wanted to start my own investment strategy, and contrary to what a lot of people believe, I really believed that active management could work, but it just needed to be done in a very different way than traditional mutual funds. So I leveraged a lot of kind of what I learned on the buy side to create a strategy that I believed would outperform the market over a long time period. It's really kind of grounded in three things that I learned on the buy side. I think the first thing that I really came to believe is that time alpha is more ripe for exploitation today than it really ever has been. So if you kind of think about that, we just have so much information at our fingertips. There's just data flow that's constantly bombarding us, and everyone's so focused on the short term. I think it's really, really hard to have an edge there. And I especially think it's hard to have a consistent edge in the short term. And I think another thing that makes people so short-term focused is there's a lot of career risk with thinking long-term. And so kind of the result of that learning is that I just think the patience and the ability to look out multiple years can really be rewarded in the public equity market. The second thing I learned on the buy side was really that the small cap space is ripe for stock picking, and especially for compounding. It's an area of the market that's not as closely followed. You're finding these companies earlier in their growth cycles. And so if you can really get comfortable with a unique growth company, again, early in their life cycle, you can get some really compelling investment opportunities. Again, if you just have the patience to look out longer term. And then the third thing I learned is you've got to make concentrated investments. So if you're going to run an investment strategy, you need to beat the market, right? If you're going to charge fees. And so, I think having a very concentrated strategy in high quality businesses makes a lot of sense for beating the market. And then the reality is there really just aren't that many unique growth companies that will outperform over a long time period. And so you should really concentrate all the investor capital in these unique businesses. I think a lot of people think that a concentrated strategy means more risk. And I actually think the opposite, right? I think if you're really truly focused on just high quality businesses, you're actually reducing the risk of the portfolio versus if you're at a very diversified fund, you're inevitably going to be investing in some kind of lower quality companies that I think introduces more risk to the portfolio. So kind of the net result of those three learnings is I started Headwaters Capital, and it's a concentrated mid-cap growth strategy. I've got 21 holdings right now, and the goal here is to tax efficiently compound investor capital and generate returns that beat the market through a cycle. So I'm trying to own pretty unique, high quality businesses. Like I said, early in the growth cycle, the businesses need to have some sort of a competitive advantage so that they can actually capitalize on these high return growth opportunities. And then once I find the businesses, I just want to be patient, own them as long as they are still in that growth cycle, and allow them to mature and kind of capitalize on their full potential. One of the things I'll tell, investors or potential investors is, look, if I can't analyze a business, come up with a confident forecast of what the company is going to look like in 5 years, it's probably not worth my time. And so this long-term investment approach allows me to harness the power of compounding. But another benefit, and it's really just kind of an output of that long-term investment approach, is that there's inherent tax efficiency given the low turnover with the strategy.
Yeah, it's a great introduction. And most of your the 21 stocks you have in portfolio, you mostly focused on America.
One company based in the UK, but otherwise every other company is domiciled in the US. And that UK business, the majority of their revenue actually comes here in the US. So it's kind of a unique story.
And how do you generate your investment ideas?
Yeah, that's I wish there was a easy answer there. I kind of just think it's an insatiable curiosity for learning, right? It's really, I guess, a mosaic approach, to investing. So I'll run quantitative screens. Although I find in the mid cap world that those aren't maybe as useful as they are in the large cap world. I like to look at a lot of large cap companies and see what big themes they're thinking about. There's pattern recognition for types of companies that are good businesses. So it's just a bunch of different ways. Talking to other investors, and there's just no one way to do this.
So if we can jump into your portfolio, if we may, can you talk about two stocks that you feel have great long-term potential? And what was your thesis for investing?
Maybe the first one to talk about would be Transcat. And so it's a very sleepy business, 600 million market cap. They're based in Rochester, New York. I do like roll-up stories in the small cap space, but kind of two specific types of roll-up stories. So it could be M&A, where you're acquiring products and services that make you a more valuable partner to your customers. And I also like M&A that produces scale advantages relative to your smaller competitors, which that's harder to do in the small cap space. But I think Transcat's actually kind of a unique example of that. So Transcat, they actually provide inspection and calibration services for instruments. And they've got a network of service centers and technicians to do all this inspection and calibration work. Interestingly, they focus only on customers in markets where there's regulatory mandated calibration. So what does that mean? Think about like healthcare, right? The FDA is going to make sure pharmaceutical companies and medical device companies, have all their equipment calibrated correctly. Aviation, the FAA is going to regulate that. Government and defense. So those are kind of the three big end markets that Transcat focuses on. And the other piece of this is it's a really high cost of failure. These three industries are high cost of failure industries, right? So let's go back to the pharmaceutical company. you need to make sure that your machines are calibrated correctly so there's no formulation errors. And the FDA actually mandates, right, that you are constantly calibrating and testing that equipment. And so the result for Transcat is they've kind of got recurring revenue to perform this inspection and calibration work. I think maybe it's helpful to think about some representative customers here. Merck, Johnson & Johnson, Parker Hannifin, just a few of Transcat's big customers. So kind of established, right, they've got recurring revenue here, but that by itself, right, doesn't produce growth outside of maybe some small price increases. I think what's really interesting here is Transcat has a big growth opportunity ahead of it because a lot of its customers still do this work in-house. And again, if you think about it, right, it's just not a core competency for Merck to be performing all this calibration work, right? And they honestly don't have the breadth of expertise that Transcat has. And so the trend in the industry is all these players are increasingly outsourcing the inspection and calibration work. The result actually is that Transcat's had 54 consecutive quarters of organic service revenue growth. And I expect this to continue for a very long time. So I guess that's the growth opportunity. And actually, maybe thinking about kind of inside of that, a really interesting kind of piece of the Transcat story here. And this isn't what you would typically find for a growth investment. They have a very small TAM here. So Transcat actually estimates that the TAM for the global calibration market is only $1.6 billion. What does that really mean? It means that larger competitors just aren't very interested in this market, right? There's no reason for a large cap or even a mid cap company to focus on this business. And it's just not big enough for them. And it actually has a similar effect on the smaller players. It's an industry where you need scale. So you need to have the network to be able to service everybody. But again, if it's just not big enough for you to make a lot of investment here, it kind of keeps the smaller players from focusing on it and trying to roll it up because, again, the TAM's not big enough. So Transcat's the industry leader here, and they've got the scale and they've got the expertise, and the result is they don't have a lot of competition at the top end of the market. So they're able to win a lot of the business, again, from these representative customers like Merck and Johnson & Johnson. And then the other impact here of that industry structure is they actually are the preferred acquirer here. So you may have a regional competitor that's good at, one specific service or calibration, type of work. Transcat can then go acquire that and add it to the portfolio. And so again, they're broadening their geographic reach, they're increasing their service capabilities. And so they become a more valuable partner to their customers. And so it's a business that's done a lot of M&A, and I would, expect it to continue doing a lot of M&A because they only have 8% market share in a very fragmented industry today. That's kind of the industry perspective. They are growing organically, kind of high single digits, again, driven by the outsourcing trend. They'll complement that with some M&A, so they'll probably be growing top line double digits. Margins will steadily improve as they get more efficient with their calibration work, and they just have the natural operating leverage that comes with being a bigger business. It's very capital light, so they generate a lot of free cash flow, and they can use that and deploy it into M&A. So kind of hopefully, like with that background, I've kind of laid out kind of like the business, the competitive advantage, the financial characteristics here. And then, like I said, there's usually a fourth piece here, which is management that I'm looking at. The CEO here, he is kind of the godfather of this service and calibration industry. So he actually founded basically the exact same business as Transcat called Davis Initech and sold it to Danaher in 2008. That business it's now a part of Fortive. It's called Tektronix. They're the second largest player in the industry. CEO obviously knows that business very well, but again, it's part of a much bigger company, so it's just not a big focus for Fortive. So after he sold this business to Danaher, he went and worked at a company called Simco. They're actually the fourth largest player in this testing and calibration industry. And then he ended up a couple of years later joining Transcat. And when he joined Transcat, he was kind of the impetus for trying to grow this service and testing business. And so the point of that background is that he knows this industry better than anybody else out there. He knows everybody in the industry. And so it's another reason that Transcat is kind of the preferred acquirer and kind of roll up of this industry. So as I kind of think through again, back to the four pieces, we've got good business attributes, competitive advantage, the financials look good. We've got a management team we can trust in. Now I just need to have the patience, right, to own this business and let it grow year after year. So that's the story on Transcat.
Okay. Yeah. Thanks for sharing that one. And how about a second company you'd like to talk about?
So the second company is called UFP Technologies. This one is a $900 million market cap. They're located near Boston. This one's a little bit more of a business transformation story that I think is kind of on the cusp of becoming a compounder. It doesn't quite have the history. And I think that's really the opportunity right now. So UFP, they actually design, develop, and manufacture custom engineered components and devices and packaging. And it's primarily all for the medical device end market. Think about the company, they've got manufacturing expertise in the form of they're very good with specialty materials. They have a lot of specialized manufacturing equipment for molding, and they've got FDA clean rooms so they can manufacture stuff in a sterile environment. Obviously, all this is very important to the medical device market. Maybe some representative products here. So they do surgical robotic drapes. They've got some vascular tools. They've got wound therapy. They've got some orthopedic products. Just kind of a range of items in the medical device end market. So I mentioned it's a little bit of a transformation story. So I think it's interesting to go back and kind of look at the company's history. Very interesting. They actually developed a cross-linked foam that was the insole of Nike running shoes a long time ago. And Nike actually told them that their products were too durable, meaning that they would not wear out. And so customers weren't replacing their shoes as often as Nike would like. So two things there. One, I think UFP realized the value of their manufacturing and materials expertise. But two, Nike ended up moving that business offshore. And so the CEO realized this is kind of an existential threat to his business. He had a lot of exposure to the consumer end market, a lot of exposure to packaging, just like very commoditized things. And so in 2014, he made a decision. He said, okay, we've got good manufacturing expertise with a bunch of different materials that can be very valuable to our customers. We're going to focus on some key end markets. So we're going to focus on healthcare. We're going to focus on military. And they've got a little bit of automotive, but that's a very small piece of the portfolio today. The result is now they have exposure to a healthcare industry, right? That it's just a much better end market to serve, right? So when UFP gets designed into a product, it has to be FDA approved. So there's very high switching costs once UFP gets designed into this product. They've got long product life cycles, so kind of 7+ years. These products have steady demand because they're consumable generally. So you think about like kind of single use or single patient devices. And the medical procedures are just not really deferrable for very long. So that also creates recurring revenue. And then obviously you've just got secular growth from the healthcare end market, just from an aging population. They did this huge portfolio transformation, starts in 2014 when healthcare was only 35% of revenue. They took kind of 4 years to consolidate facilities, invest in upgrading their manufacturing capabilities, they did an ERP upgrade. All that's to say, look, revenues stagnated for a while, margins were under pressure. The stock just didn't do well for a number of years. But I think it really highlights the long-term focus of this management team. Like they knew they had to make some tough decisions, punish the business in the short term to be in a better place longer term. And so after they did all that kind of consolidation and rationalization in 2018, they did a big acquisition of a company called Dielectrics. It brought them some more specialized manufacturing capabilities in the medical end market, and it increased their healthcare concentration to about 60%. And so they do that in 2018. They're kind of getting that thing integrated in 2019, and then COVID hits, right? And so they've done a really good job of repositioning the portfolio, but obviously a lot of these elective procedures and just general medical procedures took it on the chin. And so the market's kind of not really seeing what's happened at UFP. So COVID's a headwind for 2020 and really into 2021 for this company. And then in 2022, they kind of completed their portfolio transformation. So they actually did 3 acquisitions in the healthcare space, and they divested a consumer packaging business that they had. And so the net result is today it's 80% medical. They've got 26 of the top 30 medical device companies as customers. So I think that kind of highlights the market leadership position for UFP. So now the company's just got a sustainably higher organic growth rate. It hasn't really shown through in the numbers, but I think 2023 is going to be the year you can kind of see this all come to fruition, I guess. That's kind of the growth potential. On the margin side, healthcare tends to be a higher margin business for the company. But I think, a couple of things. One, they've made a bunch of investments the last couple of years. They're going to leverage those investments through increased utilization over the next year or two. That's going to improve margins. And then this kind of singular focus on healthcare means they're going to be able to focus more on their R&D for their healthcare customers. It's going to lead to higher margin wins, but that's going to be a longer term opportunity as those business wins kind of play out. So it's a fairly capital light business. They've got a clean balance sheet, less than 1 turn of debt. So they've got capacity for M&A to just add portfolio capabilities here, whether it's specialized manufacturing expertise, could be some offshore manufacturing expertise. Again, it could be geographic. So a lot of M&A potential. Again, they've been acquisitive. I expect them to continue being acquisitive. And again, then, the last piece here is management. And I think it's a great management team. So CEO and CFO have been there for a very long time. They've overseen this entire portfolio transformation. The CEO owns 6% of the company, so he's aligned with shareholders. I think it's just a good setup, hopefully here for the next couple of years as the market comes to appreciate this complete business transformation they've undergone over really the last 8 years.
Yeah, okay. Thanks for sharing that one. It does look a fascinating business. Okay, Christopher, thanks so much for sharing that one as well.
Yeah.
We're coming up to time now. Where can listeners go to find out more information about you?
Yeah. So I've got a website. The website is Headwaters Cap Management, but mgmt.com. I publish quarterly letters. They are all posted on the website. If you like kind of the business analysis I've done, each letter I try to outline at least one investment and kind of go into detail over a couple pages. You can also sign up for future letters there. You can also reach out to me directly through the website. If there's any investors out there who like chatting ideas, I'm always around. Love meeting other investors and talking about ideas. Same thing if there's anybody that works at any of these companies that agrees or disagrees with anything I've said, feel free to reach out. So yeah, website's probably the best place to get in touch with me.
Christopher, thanks so much for coming on the podcast. It's been a pleasure to talk with you.
Thanks, John. I really appreciate it.